Well, I want to welcome everybody out to the September marketing meeting, and you're with Brooks York and Sterling Smith, and we've got Ashley on there. Her picture isn't on there, but she's the one that makes all this happen behind the scenes. So we're happy to have you. We've got a few jumping on here, and we find ourselves on in a calendar month that usually the last few years has been something where we're celebrating our forward contracts as grain goes to harvest. Had some pretty good prices, even good opportunities for spot markets. And all of a sudden, it seems like the tables have turned on us and finding ourselves, especially in regards to corn and wheat, at price levels that no one likes to sell. As a matter of fact, in regards to corn, we haven't seen a price level that we really want to sell for new crop corn for months now. We'd have to go back to June to see any opportunity. And in June, there were some pretty tough conditions across the United States, 100-degree temperatures, droughts out. I want to talk about all the things that we normally do, market conditions in equities and commodities. We normally go commodity by commodity, end up in the equity markets. But Sterling, there's a couple of big questions today that I think people have on their mind that they need some practical advice on. And I don't know if we've got the magic wand for answers, but we can certainly.
You're frozen, Brooks.
So I want to start off by talking about we've got a situation on our hands here. We've got operating lines on the farm that are at rates that we have not seen for several years. We have got we booked a lot of inputs 10 months ago, 8 months ago, considerably higher than where they're at today, maybe with the exception of fuel as we see um, oil work its way back up. But the big thing, Sterling, is we've got prices that are tremendously lower than what we've been accustomed to seeing for a number of years with few opportunities. Tell us a little bit about the overall price environment. Go back to the conversation we had 20 minutes ago. What does this environment feel like in general? Is there any hope out there for anything to take action quickly that can change things in the next 60 days?
The only thing that can change, there are two drivers that have created the supply situation that we have. One is we're seeing pretty good yields, and we had, very stout acreage with the USDA raising acreage. That is the first problem. The second problem is we are having a drought of exports, meaning we are not going to move out as much corn as we normally do. The principal issue with that is China is not buying from us. And if you read yesterday's DMO, I threw in a chart of Brazilian corn production. It is up 67% from 2015. It will most likely, unless there's a weather issue, be higher next year. They will have another big year as they've increased acreage, improved technology, yada yada yada. What this has done, this has created an extremely heavy environment for the corn market. And right now, again, today we're at 478 and 3/4. We're down about 4 cents. The general feeling for price is heavy. And what's doing that is one, there's no speculative demand on the long side. All my little friends in Connecticut and Florida and Chicago on the hedge fund side are not interested in buying or being on the long side. When they see rallies, they're willing to come in and sell it. And we have seen that, much to my consternation, in the wheat market as we keep maybe grappling to, maybe I think we try and find a bottom, and we don't. And my overriding fear is we're going to see that in the corn market.
Certainly, it certainly feels like every time we get some momentum, just like we had Tuesday and Wednesday's trade, you think, well, we're going to claw our way out. That 10-day moving average wants to take hold and drive, and then only today to see a setback. Today's probably a pretty, but
You're
like you
frozen.
said, real hard to get too excited.
What would you say about corn? Well, actually, corn, compared to what everything else is doing, with the exception of crude oil, corn's getting kind of a free pass today. But as far as upside is going to be limited. If you get a little 2 or 3 day rally, and I'm not talking, 30 cents here. I'm talking 15 cents, 10 cents a dime. That may be your opportunity to do a little bit of incremental selling. Unless something changes dramatically, we either need a malfunction in South American weather or a change in tone with China. It's going to be very slow going to move this corn. And if we have river problems again with moving it, that is going to exacerbate it because that's going to leave that corn sitting here in the US. Counterbalancing that is we have a shrinking and tighter cattle herd. And that is something that is going to be a little bit of weight on consumption. Packer margins in the livestock market are negative. They're going to have to, and again, please don't kill the messenger. I'm just telling you how it is. They're going to have to raise box prices. Okay. That's the only way they can make money, and they're not going to sit here and keep killing cows and losing $30 a head. It's just not going to work. So, what that's going to do when we push those box prices up, where we might get a little help again at the margin, is we may see some increased chicken numbers. Chicken prices have come up. Processing margins for chickens are terribly opaque, and I kind of have to take a guess about what's going on. But if we see beef prices move up, we may be able to increase the chicken flock some. That would at least, I'm not saying we're going to be able to get anything bullish out of it. What I'm looking for right now,
It's a
I'm looking
swap.
for things that stop the hemorrhaging.
Yeah.
That
And Sterling,
is
that's something you've talked about for really months, is that transition from that beef pork over to poultry. We may finally be starting to see that. Sterling mentioned the river levels, and one thing that a lot of analysts don't talk about is basis levels. And of course, basis levels are really what you take home. We don't talk about them a lot in crop insurance because it's not doesn't have anything to do with our policies that we've got out there. But if you remember in our August and July marketing calls, we talked about being aggressive with some basis levels should they pop up. Folks, again, some negative news here. The next 3 to 4 weeks are going to be rough on basis levels. Well, Sterling mentioned the river, and we always talk about the domino demand of corn usage. It puts pressure on the next, which puts pressure on the next. We're missing that export demand in the Gulf to compound that. And of course, we call those CIF levels. It's an acronym, CIF, cargo insurance freight. It's essentially what your corn basis is in New Orleans, Louisiana. We take that number and it's low because we don't have that demand. To compound problems, we've got river issues. We're slightly higher on some places on the Mississippi than we were a year ago, but there's still the threat of closures. What that does, it puts fewer barges. Now remember, we've already got fewer barges because of the tariffs from a few years back. Construction levels never got back to where they were at 8 years ago. And what that does is the demand is higher for fewer number of barges. Even though we've got a little bit less demand in the Gulf, barge freight goes higher. What happens there is your basis to the farmer at locations with river terminals that feed New Orleans specifically are not good, and they're going to get worse over the next 2 to 3 weeks. I think there will be a pretty sharp recovery, mainly because of barge freight rates coming down post harvest, but they're going to be bad. And what that does, Sterling, I mean, you can illustrate this. You say, what in the heck does the river have to do with a processing plant in central Ohio? Well, again, that domino effect just does not put pressure on competitors to bid up for this corn. So that's a major missing component. So now that we've filled everybody's head with some negative things, and I'll recap the basis: bad, bad, bad the next 3 to 4 weeks with a legitimate recovery. probably not to the point that we saw last year or the previous year when we're looking at December and January basis levels. I think that's something you need to prepare yourself for. Much better than where we're at today, but not good historically, at least in the short term. Sterling, if everybody's still in, hopefully they haven't jumped out the second floor window after they've heard this so far. So we filled their minds with this negative stuff. How do we know when to sell a crop? And that's a really tough thing because we're accustomed to looking for levels like 650 and 7. And without something catastrophic, that's not going to happen anytime soon. But farmers still need money. So when do we look at this thing? I think this is when you have to close your eyes to the price. And this is a challenge. And you have to look at some variables in the market. Sterling, if
You're frozen.
forget price, an indicator, if you will.
What
What's
was
the one thing you look at?
what did you say? Okay. Well, the one thing, and I hate to, compound bad news, but sometimes bad news can be good news. There's monstrously large fund short positions in corn and wheat. I fear that we may be on the precipice of a period of deep risk aversion. Okay. Meaning, now, if I'm a hedge fund and I am short corn and Mr. Griffin comes by and starts pounding on my desk, what are you doing to make me money? What do? That short position, there is the potential, and this is again, I'm fighting on the margins here because I don't have a lot of great things to offer at the moment because that's where we are. But if we were to see a big risk off situation where, for example, right now the S&P is down about 40, 38, 40 points on the day, put another zero behind that, down 300 or 400 in a day, that could produce a very quick and short-lived short covering rally in corn and wheat. That would be one of your opportunities because what will happen is funds will come in, they'll buy all this back to reduce their risk exposure. They want cash, they don't want to be holding this margin because one, corn, it's low. How much lower is it going to really get? Well, we're probably a lot closer to the bottom. And if we could see something like that, that would afford you an opportunity. So again, please read the DMOs and please listen to the podcasts every day. Be paying attention to this because the thing about this, it won't last very long. That is one possibility where we may be able to see prices actually improve a little bit. As far as any other given indicator, again, pay attention to your basis. Maybe expand your marketing area a little bit to see if you can find somebody who has a more competitive bid. That's really about what we've got here. One other thing that could help us would be a break in the dollar. The dollar right now has been in a very steady uptrend. It's higher today. Part of that is we're engaging in quantitative tightening, meaning the Federal Reserve is reducing the amount of dollars, twice a week that are in circulation. Well, this is just like when a company buys its stock back. That puts an actual floor under things. If we could see something globally that could spike the dollar lower, that's something that can produce some price energy and might help. The other thing would be a softening in relations in China, but again, I wouldn't count on that happening. So this is a very uncomfortable situation right now. In terms of a price level, we got a big batch of short covering. We could go to $5, $5.15. However, that will be a selling opportunity. And the thing is, the funds cover all this. We might see the wheat up we go, and boom, 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 it gets hammered right back. So,
Sterling, I think you do a good job of analyzing some fundamental things out there. I especially like what you put out on Fridays, and that pertains to these spec funds and where they're at. And of course, when spec funds are long, is a great time to be a seller. And like Sterling said, it feels like we're in kind of a long-term risk aversion, which means If they get long, they may. The other thing that I want to throw out there is RSI, or the Relative Strength Index. Sterling, if you were watching daily RSI, what is the value that you would look at on that to say, hey, you know what, today may not be a bad time to sell? Is it 55, 60, 65? What do you like?
Right now we're at 44.99. If we could get that up to about 53 and a half, maybe 54, that would be good. And when you look at the Tech Tuesday, I also put in a stochastic. What the stochastic is, a more precision. It's more something that a hedge fund would use. And if we start to see that, and if you see in the comments, have crossed in a bearish manner, that's usually a warning that you should probably be unloading corn sometimes rather quickly, because these markets do move fast. So if we can get, again, if we can get it to 55, that would have a corresponding price. We're at 479. Oh, depending on how quickly it were to do it, you might be able to get to 492.
So, Sterling, I want to address some questions that are out there. I've gotten a couple on my phone, one in the chat. Aaron asked about where can carryouts be? And remember, the big variable here is exports on corn. She asked specifically to corn. 2.05 billion is the projection for exports. Okay. This is my opinion based on talking to some people that work in this day to day. Is that's achievable only without Ukraine playing a viable role in exports. Otherwise, we may be 2.2. We could lower exports to 1.8 billion, which would then increase carryouts, I think, in a maximum to 2.3 billion. Okay. Put that in perspective with this year, 1.3 billion ish. It's not double the supply, but it's awfully close. Okay, that's what we're dealing with here. That's the severity of it. Next question I had that came across was, why would a producer even consider selling these corn levels, as you know, with a 591 for most of the country as our projected price on crop insurance? Why would we consider it? And in a perfect world we wouldn't, right? But in the real world is we've got we've got we got few alternatives right now. Let's talk about those. When a farmer takes excess grain to the markets, in other words, the bins are full, they must move the corn to the markets. Nobody wants to sell it, and they're not right now as a rule of thumb. But what they're doing is they're lining up to the commercial market. Basis levels are thus being driven lower because the longer the line at the elevator, the less that a commercial has to pay. And so they're opting to go with basis contracts. Now, when we look at that December and March spread, a lot of farmers say, I want to go out through February to have a pricing opportunity. They can deliver in and set basis, but there's about a 15-cent spread between December and March. And so wherever that basis is at, I'll use an example. In a river market on the lower Ohio, we're around 40 under today. Okay. Yeah, 40 under will get you to about Thanksgiving, and then you'll have to price or roll. The next roll is to the March, which is a 15-cent spread. That would take you to 55 under. You kind of see where we're coming from. You're already starting underground when you're locking in that basis where it's at. The other option is going to be your traditional storage, and those fees are going to be pretty steep. The larger the carry, the larger that fee is. So there's not a lot of good alternatives right now. And unfortunately, when they see that interest coming in at $5,000 a month on their operating line, a lot of producers, they may sell this thing just to get the bleeding stopped, maybe on interest. But it's a good point, is we're getting close with average APH type yields. We're getting close to insurance maybe having our back here. We got to be real careful what we say here, because if you're on enterprise units and you start off harvest and it's bad, but it gets good as we go on, we can't really go in and say that 80% of 591 is where your claim starts, because it's all based on a lot of different variables, especially yield. But the bottom line is we are getting close. We're getting very close to, insurance having our back in a lot of cases across the country here. I would say in another 25 cents, claims go up tremendously. So there's not a lot of incentive to sell. Unfortunately, when that farmer puts grain on open storage, DP, basis contract, the market gets that grain. And so the market does not have to pay up for it. It's shipped out, not on open storage, but on DP and basis contract. It's shipped out. The market is supplied. Any demand that's there is met, and there's not a lot of incentive for the price to go up. So it's got a long tail, Sterling. Market's been
Yes.
fed. It doesn't have to bid up, and just kind of adds to our angst a bit on corn.
Yes.
So I think as we wrap up corn, I want everybody to take this away from it. Don't look at the price. Look at some of the historic variables out there that we just identified. Look at RSI. Look at the spec funds each Friday. Look at the fundamental things that Sterling's talking about. Um, but ultimately, on corn, I'm afraid that it's saving grace, and I'm going to do this as a transition, Sterling to beans. Corn's saving grace may have to come from soybeans over the next few months, because as we look at inputs, we look at interest rates, planting beans in the United States is going to be very enticing next year. Corn is going
You're frozen again.
to have a market that might be able to help us long term here.
Maybe. If you can all see this, I'm showing a chart of soybeans right now. And as you can see, can everyone see that? Is that sharing?
Yes.
Okay. Now, soybeans, as you can see, we are still at reasonably well levels. We had a pretty good bounce, back in June, July. We had another little bounce in August. And since then, we have kind of turned a bit heavy, and we're not having much fun today. This $13 level seems to be, at least so far today, your low was 12.98. Notice we're trading at 13.04 now. If we look at the stochastic down here, we're almost to a buy signal. Almost. It's very important when you use this thing to make sure you have the signal and don't anticipate it. The RSI is getting very low. We're down around 36. We may be getting a little overdone in the soybeans on the short side. I'm pretty sure there's funds kicking out their long positions, and that's driving it. We've seen very, very good crush margins. That's one of the reasons I throw that into the podcast and talk about where crush margins are, because as long as those stay elevated, that helps create a floor for this. If we can get a bounce in soybeans, and I'm not talking we're going to go back to $14, but if we could bounce the beans 50 or 60 cents, that might in turn help the corn start to lift off a little bit, and that could mix in with some fun short covering to help produce, that little quick rally that I think may be in the market. But again, if we start trading below 13, there's a lot of air all the way down to 12.50, and this market may not be all that well supported. But right now, as I speak, we're holding up okay. We did get a itsy bitsy buy signal over the last 3 days, and it failed, which isn't encouraging. But if we can see buying at the end of the day, that tends to be a little bit better of a condition than just selling at the front of the day.
And we've seen a little bit of that over the last couple of days. I think beans were kind of the comeback kid. Tuesday, if I'm not mistaken, kind of started off a little slow, came back. Hoping that same thing happens today, but boy, we're not off to a very good start at all on the markets. Now, Sterling, in regards to beans and corn, let's talk about that balance sheet. Aaron asked about corn, and we had to throw out a number of, I think I said 2.3 billion. That might be a little high. Okay, that's probably the highest it can be. But beans, I mean, we're looking at a different I mean, it's a completely different game here. Help me out. WASD came out at 220. Is that correct in the last
Yeah.
report?
Yeah, we're at 220, which gets us into at least a tradable situation. You get north of about 260 in beans, it gets heavy, gets south of about 180, which isn't that far away. All of a sudden, you start to get some bullish undertones. We opened, we had one new processing plant is just now accepting soybeans up in North Dakota. It's not a very big plant, but it's better than nothing. China's appetite for soybeans will probably remain stout, unlike corn. Global demand for soybean meal, the one bright spot that I have on today's export sales report is what, Brooks? It's my favorite commodity. Soybean
Soybean meal?
meal. Soybean meal. We saw a nice uptick in sales. And part of that is Argentina. One, they're not Brazil. Okay. Oil
And
of South
and that's a
America
big change
together.
for Sterling. Sterling, if you know his personal email address, it's got pork belly in it. So this guy, we've completely transformed him since he came from New York City. He's now a row crop guy, and you're going to have to change your personal email address a little bit, Sterling.
Well, I have to do that in honor of the great pork belly futures. And when I broke into the business back in 1993, 94, I worked for a guy named Joel Greenberg, who was a legendary local in the livestock bit. And I learned a lot about the livestock market, and things haven't changed. And belly prices have been something that have been a motivator in helping keep hog prices stout, in that belly prices are wickedly volatile. They make natural gas look like, the kiddie ride at the amusement park. And, if we can continue to see better demand for bacon, that will help us out a little bit. But globally, we are exporting more soybean meal because Argentina is not as efficient at producing it. The quality of the meal and the amino acids, et cetera, in it aren't as good. And that's opening some new doors for us that will help the soybean market in a much more permanent way. Think about it. If you're in Northwest Europe, which is, think the east coast of the United States, very densely populated, not a lot of land to grow soybeans or canola, you're going to need to import this. They're not inclined to build processing plants there. They're not China. They're going to be inclined to buy the meal for their animal feed. And that's something that's going to open some new doors for us. Because
You know, a big
Argentina is losing their traction on it. So that's something that can help the soybean market out. And if we can see acreage move, we see some more beans, probably won't be that adverse on prices, and can lose some corn acres next year. That will help the corn price.
Sterling, it's almost as if we've got two commodities in one. You got soybeans and soybean meal. And I think as we look forward to the weather in South America, we really need to kind of separate what's going on in Argentina and what's going on in Brazil. Because
Yeah.
Argentina, we found last year, really that drought last year has probably given us as much as 50 cents to a dollar in our bean markets in the
Mhm.
U.S. this year. And we didn't necessarily see that in Brazil. I want to ask you a quick question. So we got a situation where you made a statement that a slight incremental change to corn yield is not going to change things much on a balance sheet. At 220 million bushels left over, very tight, very tight. Um, Yields are still going to be watched across the country in regards to beans. Last report, help me out on WASD, 50 point, what was it on yield?
50, I think it was 50.2, if I remember right.
50.2. Take off half a bushel. If I don't have the balance sheet in front of me, I'm calling this by
That's
memory, but
40,
multiply times
40, 40. That would
42
be,
million. Yeah, take
yeah.
40 million off that. That gets us into a much different situation. So I'm gonna poll the audience here, and I need everybody to use that chat button. Um, what are you seeing in your neighborhoods in regards to soybean yields? I know it's early, and a lot of places, haven't even started. But what are your thoughts? I'll tell you what's going on down in Southern Illinois. We're about 15% harvested on soybeans, I'm going to guess down here. We got an early start. Some folks got planted in April with some 2.7s to um, 3.1s that have been harvested. Now, here's the thing. Aaron just put on there in southern Indiana 70s, little tick lower in Illinois. I would say we're mid 60s. The one thing I will say is considerably lower than the start we had last year. So I think last year we got to the field even in southern Indiana and southern Illinois, and we were seeing some 80s and even some 90s. And we didn't see that out of the early yields this year. There's hope that maybe the longer season beans yield a little bit better. But I'm shocked here. I've got several people replying back above average for sure. A lot of them talked about 70s or 80s. That's got to be good. It's like North Louisiana, upper 40s to low 70s. So it's going to be really tough to determine where we're at. I went to an agronomy night, I think 10 days ago up in central Illinois, and there was some concern about anthracnose in beans that might take 3 to 4 bushels off top end. And we don't normally think 3 to 4 bushels as a big thing, but Sterling, nationwide, we're measuring this thing in tenths of a bushel, and
Yeah,
it's a big deal.
exactly. And here, let's go from central Nebraska all the way across. Well, let's just take 80, 100 miles either side, 125 miles all the way to Chicago. We had a nasty, nasty blast of heat right during pod set. Right, the heat could not have been turned on worse. I haven't gotten any yield ideas yet. I think the guys are just really getting started in Nebraska and Iowa. But we took a lot of heat, and conditions in Iowa, if you look at the drought monitor and the drought change, have been a bit dry. So if we knock, our bean yields here and we knock them down across to Iowa, and again, it only takes a half a bushel to really move things. We knock it down a bushel, that takes 80 million off that balance sheet. Suddenly we're at a 140 balance sheet. That gets ferociously good for beans. So
Let's dream for a second here, Sterling, because and I say dream. I don't want to say this is our only hope for prices in the short term. Outside of South American weather, this may be our only hope for prices in the short term. Let's dream for a second. We cut carry out to 180. What does that do to bean price? And I'm just going to put you on the spot. Where do soybean futures go at 180 million bushel carryout, knowing that there's 111 million acres getting ready to get planted hemisphere away?
well, it'll create a tight supply right in there's windows when there are beans to be exported. If you watch the export report, we look at inspections. The reason I look at that is to see how much and how quickly we're moving. If we were to see those yields cut, we have that window, mid-October through the first week of December or so. You could see nearby beans. People get hungry for them, and market beans are naturally a little bit more nervous. Well, we could retrace back to 14 and a quarter
Now, what?
safely. That's also, I'm working on assumptions that we are going to have a brutal macro picture. If
Right.
my assumptions are wrong on that, maybe we get to 14 and a half.
Yeah. The one thing that will happen is basis will be extremely good if we would see anything like that happen across the U.S. I don't know what the likelihood is. I know Pro Farmer came out sub 50, I believe, on their tour. If something like that happens, this could happen. So we've got a little bit of hope here. Again, if you're looking at soybeans, I think we've got to take our blinders off when it comes to the price that you want to sell at. I really like those things that we talked about. I really like RSI. I really like spec funds. Looking at that Friday report, Sterling goes over, you'll see RSI at the bottom of all of his charts whenever he puts them up on the emails out there. It's something to just take note of. RSI, I just had a text come through here about 5 minutes ago, Sterling. What's RSI? Relative Strength Index, scale 0 to 100. What it does of the price in the commodity. So the stronger the momentum that the market's going up, the closer to 100 we become. Whenever we have no momentum and we're continually getting beat up and beat up and beat up, that goes closer to 0. So we want to be sellers when the market has that momentum of going up.
Yeah, and
And that's why Sterling indicated 55.60, I think, early on that question that I
right.
asked
And
you.
here, if you look at the chart that I have up here, this is the same chart I used in the Tech Tuesday. You can see up here when beans were expensive, we had stochastic was way up here, and you see this little red line? That we were brushing up against it. And some of this, this measures intensity of move. It doesn't measure magnitude, which for magnitude, I use a thing called DMI and another thing called ADX. And I don't want to get too far into the weeds with this, but you can see when we get green, we get cheap. We're getting down here. One thing I'd like to warn people that we can stay down here for a while. And as you can see, it took the cross in the stochastic again to indicate here just as we started to achieve liftoff for this little micro rally we had here, or again here with the much more broad-based rally.
And this is Sterling mentioned we can stay depressed for a long time. We can. And I guess fortunately or unfortunately, however you look at this, and I know I've got a few folks that have followed this long term. Autumn and Aaron on here, Brent on here. They followed it a long term. This is actually more the norm for these things to stay depressed. And here's the good news and the bad news with that. Okay. Whenever RSI shows itself, whenever spec funds line up with RSI, it may not happen very many times, but what it does, it gives you more certainty that you're making the right marketing decision. And so if we get that happens 4 to 5 times a year, and it may only happen that often, it may not happen in a year, it may happen once. On average, maybe a dozen times during the year, that's a great time to make sales. So you feel more certain when you got that environment around these sales. And that, I say that's a positive thing. Well, it may not be whenever we're in a depressed pricing situation, but it does give you that comfort and that confidence to sell, knowing that you're using something besides your gut or what you saw on the internet today to make those decisions.
Yeah, and again, we have to be careful about news on the internet. Be real careful about any news stories that get printed, especially on weekends, because a lot of that is news. Reuters and Bloomberg and the big news providers are not going to give you the very best news for free. They are going to give you things that are going to get you to click on it so they get an ad impression. So make sure I try to do a very good job of filtering out what really matters and what doesn't in the commentary, because you can see things on a weekend that may or may not be the most fresh and most current thinking. And another thing about these indicators, a lot of these hedge funds, what they are hiring, they're not hiring economists. They're hiring mathematicians and teaching them economics, because a lot of this is very computer driven. And when you get certain indicators, they come into play and the computer says buy, the computer goes in here and buys it. Okay. That's something that goes on. And you see today's movement. Well, we shouldn't be seeing buying, we should still be selling. And they break this down into time brackets, sometimes as small as a few seconds in the equity markets, and maybe about 10 minutes in most grain markets is typically where this goes on. So there is faith, there is self-fulfilling prophecy within these indicators, is what I guess I'm really trying to communicate.
Yeah, I think it's a Moneyball game. You ever seen the movie Moneyball?
Oh yeah.
They got that from someplace, and it wasn't baseball. It came from this world first. So good point, Sterling. So bean questions. If anybody's got bean questions, throw those out there right now. Bean basis. Let me talk to that for just a little bit.
And
Obviously,
I have one other soybean point.
All
or
right.
it can give you some bad news that is good news. As we all know,
I'll let you wrap us up and transition to a new commodity after basis talk here. Basis on beans, it's not going to be immune to the season. Things are going to be weaker over the next 3 to 4 weeks. The good news is, I would say by October 21st, due to the exact situation we talked about, the strong demand, the lack of supply, we will see a rebound in bean basis. Here's the conundrum that farmers are going to find themselves in. If you're taking a commodity to town to sell it, do you sell corn or beans? I think the nature of the beast favors soybeans just because it's not such a terrible price. Where do I think the best demand is going to be in December and January? Soybeans. I talked a little bit about that in the last meeting. I don't mind turning soybeans into cash this fall, but I certainly want to have some to sell in December and January because basis levels should be pretty strong at that period of time. And also remember where we're at in Brazil and Argentina. We're right in the middle of their growing season. I'll argue this may become our volatility period of the year. We may be transitioning from that June July period in the U.S. to December January long term. I think you're going to see some sparks out there.
yeah, I think you're going to see a bifurcation there where you're going to have a new volatility period where we get in that flat spot. Brazil starts moving beans, right around the Super Bowl, right about then. So you're going to have that window where the market is going to be a little bit tighter than normal, and that can help increase volatility. And you may have questions about yield, et cetera, depending on how things go. So we may get to, we're going to have a situation where we're going to have two windows with that.
Tell us your good news or your bad news that may be good news.
Okay, as we all know, the price of crude oil is going up. And here we'll just share a picture of this. And again, please don't shoot the messenger. This is what it is, and we can't, it's up to us to govern ourselves on how to handle it.
Go ahead and start with the good news, Sterling. Come on, give us something good here.
Okay, this is the price of crude oil, and it is, as you can obviously see, is screaming higher. Now, I'm going to put up a chart of something, why this is going to help out. This is a chart of soybean oil, and we're going to take this bad boy back. We're going to go back to 2014. And there you go. Notice the price of soybean oils basically doubled. And that is because of this stuff called biodiesel. And this is something that is supportive. And when we see higher crude oil prices, that works to elevate the price of soybean oil. That improves crush margins. That improves processors' ability to pay up for soybeans. And this is new. There are some bad knock-on effects of this in terms of food inflation, but this is something that is helping out and certainly going to help be a much bigger component than it used to be. Normally, you crushed for meal, and that's good. And the oil as well, it's salad dressing. It's what you get as the byproduct. Soybean oil having a new prominence and a new higher price perspective is something that in general is also going to help support the situation. It's not a one-to-one correlation, but again, this is something that is in the positive camp for this situation.
Very, very interesting. I think that's I know back processors in the late 90s, early 2000s, soybean oil was a byproduct that helped out a little bit, but not much. And it's become a different game here long term.
Mm-hmm. And
So,
also, if we see bigger chicken supplies, chickens consume a lot more meal in their ration versus cattle. So that's something that if that can help those meal prices, which are also nicely stout, and we can export more, that will be a knock-on effect that can help the price out for soybeans.
Sterling, before we leave soybeans, one thing that I think that it may affect our business as agents and also as an AIP, and farmers should know this too. I think with the situation that we're in, this is going to be a challenging year for a lot of farmers for cash flow. It's not the years that we've seen the last 4 years. I think we're going to see a transition here in 2024 from corn acres to bean acres. And I know I've been saying that a little bit over the last couple of years, but I think this one it's for real. I think we could see those acres be neck and neck next year. If not, soybeans maybe pass up corn just a little bit. So we got to be mindful of that. If you know your producers are going to be heavy beans, we got to look at that December, January time period to make some forward contracts. I think that's going to be critical because I think by March
Mhm.
31st, when we see that acreage report, it's too late at that point in time. So be on your horse on this one. December, January, gear up for maybe looking at that November futures market during that time
Yeah.
period.
Yes, I think we are probably looking around the corner. Let's look around the corner, let's say 5 years. We very likely may see a structural change where we see more soybean acres, fewer corn acres, and particularly those marginal corn acres that may prove very expensive to plant, those may have to find themselves doing something else. That that is one thing that if we continue to see this economics where we're looking at sub $5 corn for, a prolonged period, that's something where we're going to have to make a shift in acres to tighten up that supply domestically.
Yeah.
I don't think there's any way around that.
So I talked to a farmer yesterday, Sterling, who was gearing up to plant a lot of wheat. And I asked him the question, why? And the answer was because we're farmers and that's what we do. Now, don't get me wrong, wheat's not a primary crop where I'm at. It's something that is largely kind of depends on how much time you've got in the fall, what the weather's like in the fall, how's your corn harvest gone in the fall. There's a lot of variables out there. It makes it really tough to market when you don't know exactly how much you're going to plant, if any. But you got to scratch your head a little bit. We're seeing extremely low basis levels for soft red wheat across the country.
Mhm.
And I know soft red is what'd you say, a kiddie ride at the theme park compared to hard red that's out there. But nonetheless, the situation's a little bit the same. Wheat, as we kind of transition to wheat is sick. It does not seem to want to. It's been knocked down and it's staying down no matter how long the count is out. Is there any hope for our wheat situation long term?
Well, long term, if you have quality wheat, and SRW is going to be a problem. I have seen some sparks of hope here. We're going to jump here. We're going to go to Minneapolis here real quick. We have some itsy bitsy trend line support that we're testing, and we're not that great of a technical picture, but better quality wheat and better quality protein is something that can help at least lift Minneapolis and Kansas City a little bit. SRW has some real problems. And again, I always get scared when I type in that W with that one chart. That means I'm pulling out a big old long chart because we're going to have to go back in time. And when we go back in time, that's usually not a good sign. As you can see, wheat prices, and we're going to get back previous to pandemic. Wheat prices, here back 17, 18, we're trading $5 a bushel, 5.25 a bushel. I'm not saying we're going there today, but our export situation is not good. It was not good last year. It is so far this year not off to a good start. Inspections, accumulated exports are all running well below the 5 year average. Granted, we're not a big player in the global wheat market, but that's one incremental thing that can help us. The other thing is, I think we're going to start seeing, maybe some fewer wheat acres, particularly in the Dakotas, that are going to get switched into soybeans. And that's something.
Certainly with the soybean processing building its presence there, it feels that way right now. It certainly does. Again, kind of another testimony to more bean acres next year. Maybe not at the expense of corn this time, but the expense of wheat. So Sterling, what do we look for here on wheat? Because a lot of these levels are below break even numbers with average yields. What does a guy look for in wheat? I mean, number one, if we're looking at winter wheat, number one, we got to get it in the ground. We got to know what we've got planted there really before we're going to pull the trigger. What do we look for here? What are some price levels? What are the indicators? Are they different than corn and soybeans? What's a guy to do here?
Well, these mechanical indicators, these work for everything. I don't care if you're looking at corn, wheat, shares of apple, whatever. They're mathematical, they're mechanical, and they work for anything. Right now, what I see is the RSI is low, but it can be pressed lower. If we look at our little friend, the stochastic here, we break through support here on Minneapolis, that will give you another sell signal. Minneapolis, if we can get up north of about 780, you're probably in the selling zone. We'll see how this itsy bitsy, I'll draw a line here for you. We have some very, very tentative support right there. Price levels, if we break that, we're probably 750 in Minneapolis. Maybe your upside might be 780. The problem is every time we get a rally in here, somebody comes with a hammer and hits us over the head. Now, funds are short an enormous amount of wheat right now. An enormous amount. It's got to be north of 80,000 contracts. So there is some fuel if we can get some short covering to maybe push the market higher a little bit, and just maybe if we see interest rates move higher, funds might be a little bit more restrictive in the amount of size that they can actually trade. So when they come to hit it with the hammer won't be quite as big. So right now I see wheat sideways. If we go below this, that will be a true problem. I don't think we can really get above $6 has been pretty much a pretty good wall on SRW.
It certainly has. It certainly has.
Globally, globally, the world is hand to mouth to wheat, and we're not seeing, any great shakes in terms of exports improving anytime soon. We did see one little piece of news, and again, we're digging here. Egypt was trying to buy some wheat from Russia. Russia tried to put a wheat floor in. Egypt didn't want it, and they're coming back into Western Europe to look for wheat. If Russia decides they need to, pressure, put some floors on the wheat market and try and raise prices, that is something that eventually could have some knockoff effects and maybe propel it. Right now there's a quiet, aggravating Cold War going on between the U.S. and our adversaries. It's not with the military; it's with economics, and perhaps ideas that maybe if Russia thinks they can press wheat higher like they've done with oil, maybe they'll try it, and that's something that might work to lift prices.
Sterling, how does yesterday or day before, I guess it was, Ukraine, Zelensky was in the U.S., and all of a sudden you saw a hint of, maybe a willingness for some type of peace deal. It's far fetched, and I know that particular proposal is not going to take hold. Um, I was talking to, and I kind of end this with a question to you. I was talking to a trader that had lived just outside of Odessa, and they made the statement that it the infrastructure going to these export terminals had been destroyed so much that it really didn't matter what got planted in some cases in the interior of the country. It would be really tough to operationally get that weed out. What's going on over in Ukraine right now? Do you see, could that be added bad news to the wheat market if you see a peace deal come across anytime soon?
Oh, there may be. I think any war risk premium has gotten knocked out of the market. One of the fascinating things that I saw go on with the wheat rally up to $12, the funds didn't blink. They held that short position through all of that. I'm sure they were trading options around it to contain and control their beatings, but they didn't really blink. So if there is a peace deal, there would, in theory, there would be a loss of risk premium. I can't say with wheat pressing, lows for the last 2 years that there's any risk premium in the market. By the same token, you may be able to move wheat. You're not going to be able to export it in mass. You can move it on trains into Poland and Romania and places like that. It might be mildly bearish, but right now I don't really see that as being an influencer one way or the other. Our problem is we need to increase global demand for wheat. That's what we really need to do, or we need to compress supply. That's the only thing that's going to really get this ship really righted.
I'll throw this out from a practical standpoint. I get text questions that come across. So if I look down every once in a while, that's what I'm doing. Um, Wheat in the bin, what should be done with it? And that's a good question. First of all, I can't speak to hard red wheat or spring wheat very well at all. This is kind of an SRW, so this is kind of limited to the Delta, Ohio Valley, Illinois, Indiana, Ohio. But you know, wheat is when you see a market like this, the bins are made for wheat. And in those areas, a lot of commercial elevators don't like to handle wheat during harvest, during corn and soybean harvest. So they essentially shut down, leaving you with very few marketplaces. Um, the carries in wheat going back 30 days ago were pretty decent on the board, but they were extremely good in the cash market. So basis levels on wheat, at least in the Ohio Valley, and some of you can kind of speak to this. And we've seen everything from 60 under to 90 under over the last 30 to 60 days, and now we're to a point where a lot of locations won't take wheat. I like having wheat in the bins. I think we also kind of need to rethink our strategies in the future to gear up to hold wheat through corn and soybean harvest in those bins. I think it pays off far better to store wheat long term than it may to store soybeans or corn for a period of 3 months.
I would agree completely. If the market's going to pay you to store grain, well, if it's not going to pay you to sell it, then it's paying you to store it. That's really your alternative. And as Brooks pointed out, this is the current strip here, and as you can see, there are some fairly decent carries in there.
Sterling, I'm going to we'll switch over from the big three. Is there anything, we've got a few cotton folks on here from Texas and down in the Delta. Anything on cotton that we need to touch on before we kind of move to, I want you to talk about equities here before we get off. I know we're already at the hour mark and we'll just be on here a few more minutes, but anything on cotton that we need to be cognizant of right now?
Cotton has moved to a new higher range. As you can see, we had this very dreary, if you have to write about this stuff, range where, about 78's the low, about 80's the high, and we didn't do much. Production issues in Texas have moved us back up here. Now, the problem with the cotton market is demand. And this is going to lead right into when I talk about energies and interest rates. Consumers are becoming increasingly pressed. We're seeing higher credit card balances. We're seeing trade down in consumptive items. You don't buy the $2.28 toothpaste, you buy the $1.68 toothpaste. We're seeing that going on. That points to problems with macro cotton demand. Luxury items are doing better than they always will, but it takes just as much cotton to make a cheap shirt as it does to make a fancy shirt, or it's not enough to move the market. So my concern with the cotton is we have had this rally, and this has been entirely fund sponsored. Funds took out and bought 37,000 contracts, and it took that much to lift us from here to here, which seems like a lot, but in the scale of life, it's not that much. It's about a dime. If cotton begins to sag and drop back down into this range, we're going to have a problem. And when I talk about equities here, we might as well just start right now. I'm going to talk about competition for money. And we have quantitative tightening going on, meaning there's less money all the time within the economy. And we're going to switch over here. This is a chart of 10-year interest rates. As you can see, we have been steadily climbing. That means when the government goes out to borrow money, they have to pay more for it. Okay, and how do they do that? Well, they borrow more money. So that creates competition for money. This also means things like mortgage rates get higher. Again, competition for money. If you were able to buy it in 2020 a $350,000 house, that same amount of money that you pay every month right now gets you a $240,000 house. So as we begin to see competition for money, that creates a problem for the equity markets. That creates a problem for consumer discretionary markets, being clothing being one of them that already has its problems. So China has been pretty good about importing cotton so far, but our cotton exports have been a little bit shaky. So if we see, and here, go over here to, I'll just punch it up in right in here. Here is one of the things that directly hurts the cotton market, and we're going to punch up our little friend here. That's chart of crude oil. As you can see, we are moving noticeably, meaningfully higher. We had a little bit of a failure here. This is just enough, and this is where markets get a little weird, and particularly bull markets. This was just enough to dust us back off of overbought a little bit. We're surging again. As you can see, we are overbought. Right now, I think you're going to need to take crude oil to $96 a barrel before you get a sell-off. It is slowly increasing production. By the same token, our nice friends in Saudi Arabia and Russia want to elevate prices. They are probably going to cut production again to keep prices elevated. When we get north of 100, which I do think is a greater probability than being, say, south of 87, that's going to begin to weigh on consumers. And if we look at demand, if we look at things like gasoline prices right now, the spread between RBOB and pump prices is very low, is cattywampus. It's not where it needs to be, and we're in a seasonal period where that's going to go down. Eventually, this crude oil catches up with this, and this is going to send gasoline prices. So suddenly, consumers' pocketbooks get squoze even more, and that could be a problem for the cotton market. So again, if you have good prices, and it's not driven by good fundamental demand, but it's driven by speculative fund activity, that may be a sign that maybe prices are as good as they're going to get, and you need to take advantage of it.
A simple analogy is when someone from the outside wants to put money in your commodity, take it.
Exactly.
While it's there.
When they're offering you money, take it. And speaking of things that are offering money right now, short-term cash interest rates are the best paying asset, churning over 5.25%. And here we have a chart of the S&P 500. I'm going to use, as you can see, this is the Tech Tuesday chart. We've fallen below all the moving averages. The moving averages are crossing in a bearish manner. The stochastics are in a bearish configuration and not oversold. This is in a bearish position and dropping in, not oversold. These oscillators predict direction. They do not predict magnitude of move, meaning it could be oversold and we drop, switch to this chart, we drop maybe down somewhere in here. Right now we gapped below the 100-day moving average this morning. That is very, very bad news. That portends a challenge of the 200